All right, now that we've really talked about solvency and such, let's move on to profitability. Profitability is, you're using these analytical tools to decide whether or not the business is using the resources it has wisely. So for example, let's say you had two businesses that had exactly the same amount of assets, the same amount of fixed assets, but yet one business used its money much better and had significantly more sales than another company. All right, you would say this first company is using its assets a lot more wisely. Well, the way you're going to look at that is you're going to use ratios. All right, so the first one you're looking at is the ratio of net sales to assets. And what you're saying is how well, like the example I just gave you, how well is a company using the assets that it has. So you're going to take net sales, right, which is gross sales minus any sales returns and allowances, divided by average total assets, excluding any long-term investments, all right, because those are not, long-term investments, if you think about it, they're not anything that helps you increase your sales. That's just money you're kind of putting aside. So, looking at these, you get net sales divided by average long-term assets. Like I said, it excludes the long-term investments in the calculation. So if you're not given that number of average assets, you're going to take the beginning of the year plus the end of the year, given that total, divided by 2. All right, you may have seen that once or twice so far in this lecture. So here we go. Ratio of net sales to assets. So for every $1.40 of sales, you have $1.40 worth of sales to every dollar of your net assets. So the higher this number is, the better. So if you look at a comparison to last year in 2011, for every $1.20 in sales, you had $1 of assets. So what this is saying to you is that even though you do have more sales, not only do you have more sales, you're using your assets better because the number is increasing here. All right. Let's see. Okay, rate earned on total assets. All right. What we're looking at here is it's a very similar calculation. It's net income plus any interest expense divided by average total assets. All right, what we're doing is, again, we're looking at the profitability of assets overall. How well are we using those assets? What is the rate that we're earning on those assets? So you're going to take net income, which is net income plus any interest expense. You're kind of putting the interest expense back into the equation. All right, so you've got $91,000 plus the $6,000 of interest expense gives you a total of $97,000. That's going to be your numerator, divided by average long-term assets, and you've got 1,100,000. Is it long-term assets or is it total assets? I'm sorry, it's total assets. Shows you how well I know my equations. All right, so you're looking at 97,000 divided by 1.18 million, and the rate you're earning on those total assets, just to look at it from a different perspective, is 8.2%, whereas last year you're looking at 7.3%. All right, so you're using your assets better. The amount of money that you're earning, your ending net income, the amount of net income those assets are producing for you, it is about 8.2% this year. Right, so the higher this number, the better. Right, the rate earned on stockholders' equity. So you've got net income divided by average total stockholders' equity. So how much money is being earned based on the amount provided by the stockholders or invested by the stockholders. So here you're taking net income. You're not adding back the interest expense in this equation though. You're taking net income and you're dividing it by average stockholders' equity. So again, beginning of the year plus end of the year, that total divided by 2. So the rate earned on stockholders' equity is 11.3%, and this number being higher than last year at 10% is showing improvement. All right, the money that the company is earning based on the stockholders' investments is increasing, and you want the money to be coming from stockholders' equity, because that's where if stockholders' equity is where your retained earnings is. All right, the difference between those two equations is called leverage. All right, and you can see that here. This is the numbers from the past couple of slides, 11.3 less 8.2. You've got leverage of 3.1%. All right, and a little bit of a visual for you there. The last couple of these, that's right, we're nearing the end, is earnings per share. All right, earnings per share is probably the most common ratio that you're ever going to see. It's actually required to be on the financial statements. Earnings per share is not is a ratio that pretty much the average investor is comfortable looking at and can moderately understand. So people without a lot of financial savvy tend to look to this earnings per share ratio just because it's kind of not that so much that it's simple, but it's easier to understand than all of those other ratios. Because if you're the average investor, inventory turnover ratio doesn't really mean a whole heck of a lot to you. But if you're looking at this, what you're saying, earnings per share on common stock. Now, most people when you're buying stock are buying common stock. You're not usually buying preferred stock. Not if you're just going and you want to buy some shares of Microsoft stock, or you want to buy some shares of any basic stock, maybe Facebook stock in the future. I'm probably going to date myself by saying that since they're going to be since right now they're looking at going out for an IPO. So in a year or two, people are going to say, "Hey, where wasn't Facebook always public? How long ago did Professor Anderson do these slides?" All right, but anyway, so you've got earnings per share and common stock. When you buy those shares of stock, usually they're common. So the idea is, how much money is the company earning for its average investor? So you're going to take net income minus any preferred dividends, because if you remember, preferred shareholders get their dividends before common shareholders. So if we're trying to say how much money is being earned for the common shareholder, we need to back those preferred dividends out, because they're not allowed to have that money. That money's out the door before it can ever touch their hands. So you take total net income minus any preferred dividends over the total shares of common stock outstanding. So if you look at this, you've got $91,000 net income, $9,000 in preferred dividends. So that means the company's got $82,000 that it has earned for those common shareholders, if you will. There are 50,000 of those people out there. So you've got $82,000 of earnings per share in common stock divided by 50,000 shareholders. So for every common shareholder, the company's earning $1.64, whereas last year they only earned $1.35. So the higher this number, the better the situation is as well. Okay, PE ratio. All right, this is the price to earnings ratio, but you'll more often hear PE ratio, and this is one of the more common ones as well. You've got the market price per share of common stock over the earnings per share on the common stock. All right, so what you're trying to do is you're trying to say, well, what is a company's potential earnings here? What can we figure out what the future possibility is of the company's earnings? So what you take is you take the market price for the stock. That's right, the market price, right? We haven't touched anything to do with market price before this, but the market price for this common stock divided by the earnings per share. So what we're saying here is we're saying that the PE ratio on common stock is 25. So the total cost, the price, is $41, and the potential earnings on that share of stock is $1.64. All right. All right. So you notice one thing here. You needed to have that earnings per share number in order to do this calculation. You couldn't have done this calculation without first coming up with earnings per share. Okay. All right, dividends per share. Basically, how many dividends are you getting per shareholder? All right. So if you're investing with a company not because you expect to sell their stock for a gain, but rather because you know that they often pay out dividends and they pay out good dividends, you might say, all right, you've got $40,000 worth of dividends that they pay out to common shareholders. There are 50,000 common shareholders out there, so the dividends per share are 80 cents a share. Okay, so you're saying, if this was 40,000 dividends and 40,000 shares of common stock, then each common shareholder would get $1. But in this case, it's a little bit different. It's $40,000 in dividends divided by 50,000 shareholders. They get 80 cents a share. Okay, so just a little visual. All right, I don't think I want to talk about dividend yield. And sorry, I'm just skipping through the slides here. This information is available to you when you're taking the exam. This is an exhibit in your book or in your ebook. I would suggest printing it and having it available to you. All right. Let's just talk about annual reports for 1 second, and I think we're just about done here. Annual reports not only have financial statements in them, but they also have a few additional items in it as well that are mandatory and usually, well, not always mandatory, but some are mandatory, but for the most part they're always with financial statements. So you've got earnings per share that absolutely has to be printed in with the financial statements. You have the financial statements themselves, and these are the other reports that you'll typically see. Management discussion and analysis, a report on internal control, and a report on the fairness of the financial statements. All right, let's see if I can finish this up as quickly as possible so I can keep on this in this recording. Our management discussion and analysis. This is basically the place that management can state their own report. They can explain away anything that looks bad in the financial statements, which, this is their place that they can put their own spin on the financial statements. They might say, we know that these numbers aren't good, but this is why. So it's kind of like, it's definitely biased. Nobody's reviewing, nobody's looking at this, nobody's analyzing this. It's really the management's portion where they explain items in the financial statements, usually that don't look too good, or maybe they just want to talk to their investors and say what their plans are for the future. All right, but like I said, it's important to realize that they are biased. All right, the next thing is a report on internal control. If you remember, we talked about Sarbanes-Oxley in the first section of this, in the first half of this book in financial accounting, and there is a required report on internal controls. If the company has had internal controls tested, which it's required to do, what the report results were of those internal controls. And the last thing would be a report on the financial statements, on the fairness of those financial statements. This would be a report by one of the auditors, a CPA firm, who says whether or not the financial statement, the company is using GAAP in order to prepare the financial statements, and if they're doing it properly. There's a number of different opinions that it can be stated. A company could have several different opinions. I'll save that for an auditing class for you in the future. But the idea is that the auditing company comes in and they review the financial statements of the company, which the financial statements are the responsibility of the company to prepare, and they come in and they test them and they say, can these statements be relied upon because the company did apply GAAP properly? And if that is the case, then they will issue a clean opinion saying that yes, you can rely on these financial statements because the company did use GAAP. So that's it, guys. Done with the chapter. See you soon.